alaikum everybody. Welcome back to my channel Rapid Revision. This is question 4 of May-June 2024, paper 2 variant 1. The question here says Ahmed owns a trading business. He prepares his financial statements to 31st December each year. Ahmed had some unused office space and he had decided to use some of this to store inventory and to rent the rest to Bilal. So if Ahmed rents out his office space to Bilal, what will happen is that he will basically receive rent in this case. So this is going to be a rent receivable account which we are supposed to prepare in this question. On 1st January 2023, Bilal started renting the office space from Ahmed. So this was basically started on 1st January 2023. So that means for the current year, there will be no balance brought down because on the first day of the year, we have decided that we will give out some space to Bilal in this case. The annual rental charge is 4,800, which Bilal is basically supposed to pay. So this is going to be your income statement value. So I'll write here income statement for this. Then they are saying during 2023, Bilal paid the following amounts of rent into Ahmed's bank account. So this is going to be bank debit, rent receivable credit, bank debit, rent receivable credit. So there are two dates in which Ahmed is basically receiving the money. So bank debit, rent receivable credit. That means in the rent receivable account, I need to write this on the credit side. So I'll write here 1st April 2023. I will write here bank and I will write here 3600. And again 30th September 2023, I will again write bank because this is again being debited to the account of bank account of Ahmed. So this is going to be 2400. And the rule for incomes is OPPO. But if you guys don't know the rule, you can watch my videos on other payables and other receivables. But OPPO basically is for incomes. And now what we are going to do is that we are going to write income statement here. So income statement should be 4,800 in this case because they have already told us that 4,800 is the annual rental charge which Ahmed will charge Bilal for the office space. This is going to be 31st December 2023, which is the last date of the year, 31st December 2023. Now on the debit side, I have 4,800. On the credit side, I have 3,600 plus 2,400, which means on the credit side, we have 6,000. So that means we have received more money than what we were supposed to. We were supposed to receive 4,800, but Bilal was being generous and he gave us 6,000. So we have basically received an income in advance. So this is going to be our current liability, and the position for this, so OPPO. So this is where prepaid carried down comes. So this is prepaid carried down or balance carried down. You can call it balance carried down as well. Balance carried down. This is a prepaid income which we have received for the next year. Bilal has given us 1,200 extra for next year. This is going to be prepaid income. Prepaid incomes are the business's current liabilities because now we are supposed to give the service to Bilal in the coming year. So this is going to be 31st December as well, 31st December 2023. This account will balance on at 6,000 on both sides, 6,000 on both sides. This balance carried down will become your balance brought down on the credit side. This is my prepaid brought down for the next year. That starts on 1st January 2024. So yes, that's it for this part. It was pretty simple. You guys need to know the double entry. Whenever we are receiving the income, we do bank debit and we credit the rent receivable account. So similarly, wherever bank is in this account, you need to write income statement on the opposite side of bank, which is in this case going to be on the debit side of this rent receivable account. In the next part, this is from depreciation and disposals, and this basically, again, the question has a lot of topics, so it's like a nice interesting question. Ahmed sold office equipment for 1,350 on 3rd January 2023 on credit to Rahat. The equipment had been purchased for 3,200 on 1st January 2021. Ahmed charges depreciation at 25% per annum using RBM. He does not charge depreciation in the year of disposal. So the year of disposal is basically 2023. He had purchased this on 1st January 2021, which is the first year for this particular office equipment. 2022 also he used this office equipment. In 2023 he is selling this office equipment for 1350. So depreciation will be charged for 2 years, that is 2021 and 2022. Depreciation will not be charged in 2023 because that is the year of disposal. In year 2021 you will do cost minus accumulated depreciation. So again, cost is 3200, accumulated depreciation in the first year is 0, because we haven't depreciated it yet. We are depreciating this particular non-current asset for the first time. So 3200 multiplied by 25% is going to give me 800 in the first year. In the second year you will do 3200 minus 800, and then you multiply this by 25% again. So 3200 minus 800 multiplied by 25% is going to give you 600. So depreciation in the second year is 600, depreciation in the first year is 800. The total depreciation on this asset which we have sold is 1400. So if you know the format for the disposal account of generally disposal of non-current assets, in this case it's office equipment. Office equipment account will be credited. This account needs to be debited. I will write here office equipment. In the office equipment account, we are supposed to write disposal on the credit side. In the disposal account, we'll write office equipment on the debit side. Basically, the disposal is being debited, office equipment is being credited, and this is going to be your cost, because you need to credit the non-current asset with the cost of the non-current asset. This is going to be 3rd January 2023, because that is the date of disposal. Then basically you need to write the accumulated depreciation on the credit side of this account, because provision for depreciation will be debited. In the provision for depreciation account, I will write disposal on the debit side. In this account, that is the disposal of office equipment account, I'll write provision for depreciation on the credit side. So I'll write here provision for depreciation, and I will write here 1400, which is my total depreciation on this particular office equipment. This is also going to be 3rd January 2023. Then on 3rd January 2023, we basically sold it for 1350 on credit to Rahat. So the third double entry will basically be Rahat debit, because Rahat becomes our receivable now. Rahat is our other receivable, because we are selling Rahat a non-current asset on credit. So we are selling to Rahat a non-current asset on credit. This person is not your trade receivable. Please note this, that Rahat is not a trade receivable. This guy is an other receivable, because this person, we are selling him a non-current asset on credit. So Rahat account will be debited, disposal account will be credited. I'll write here Rahat. In Rahat's account, I will write disposal on the debit side. In disposal account, I'm writing Rahat on the credit side, and this is going to be 1350, which I'm supposed to receive from Rahat in the next few months. So now when I will try to balance this account, it's not going to balance. 2750 is on the credit side, 3200 is on the debit side, so that means it's a loss of 450. And also I will tell you how I know it's a loss. One second, we need to compare the net book value with the selling price. We'll write here income statement, and we'll write here 31st December 2023, because income statement will be prepared on 31st December 2023, and on that date we'll basically transfer the loss to the income statement. Notice this, 3200 was my cost and my accumulated depreciation was 1400. So 3200 minus 1400 is how much? 3200 minus 1400 is 1800. 1800 is my net book value, but this is my expected value. So I expected that I should receive 1800 when I'm selling this non-current asset, but I received how much? I did not receive it yet, but I decided the selling price with Rahat as 1350. So now that means I expected 1800, but this market value is basically 1350. So that means 450 is my loss on the sale of office equipment. Yes, 450 is my loss. Okay. In the next part, they are saying complete the table by placing a tick to indicate whether each amount of spending on the new inventory storage space. So there is a new inventory storage space which Ahmed is basically making for storing more inventory. What is the amount of spending on new inventory storage space? Is capital expenditure or is it revenue expenditure? So painting the walls of storage area. Painting, normally everyone everybody paints, like even if it's a house, you would paint it every year, or once in a year, or there's this kind of some painting going on. So this is kind of a recurring expense, so you call it you'll basically take revenue expenditure for this, because you need some or the other painting expense to be incurred every year. Shelving for the storage area, shelf you will only get it once, because obviously, yes, there's once you'll get the shelf. It's like the shelving is basically wooden, sometimes wooden, right? So wooden shelving, you don't need to change it again and again. You don't need to install the shelving again and again. So this is going to be our capital expenditure. Installation of shelving, obviously shelving is a one-time expense, so installation of shelving is also one-time expense, and capital expenditures are one-off expenses. Light fittings for storage area, so there's a fitting space in which you put light bulbs, so that is light fittings is going to be your capital expenditure, and fittings is like fixtures and fittings. So fittings is going to be always capital expenditure. However, light bulbs you need to change again and again. Once you might change it on a yearly basis, because obviously light bulbs they basically खराब हो जाते हैं. हाँ, so लाइट बल्ब्स खराब हो जाते हैं, इसलिए आपको लाइट बल्ब्स बार बार चेंज करने पड़ते हैं. So light bulbs for storage area will be revenue expenditure. Okay, in the next part, they're saying very interesting again. They are asking you to calculate ratios. Now, this is a ratio analysis part of the question. Ahmed's ledger accounts at 31st December 2023 included the following balances: inventory at 1st January 2023 is opening inventory, receivables, cash, payables, bank overdraft. Ahmed's inventory at 31st December 2023 was valued at 12,130. His purchases for the year ended 31st December 2023 were 97,000. In the first part, they are saying calculate the rate of inventory turnover in times. Rate of inventory turnover, if you know the formula, it is cost of sales divided by average inventory. Cost of sales calculation basically is quite easy. So cost of sales calculation is basically opening inventory, which is 9,000 in this case, plus purchases in this case is 97,000, which you need to add, minus closing inventory, which is 12,130. So when I calculate this, I'm going to get my cost of sales. So 9,000 plus 97,000 minus 12,130 is going to give me 93,870. This is going to be my cost of sales, which will come in the numerator. So 93,870 is my cost of sales. Denominator is going to be average inventory. Average inventory is always opening inventory plus closing inventory divided by 2. So 9,000 plus 12,130 divided by 2 is going to give me 10,565. So now I'm going to calculate this. So 93,870 divided by 10,565 is going to give me 8.88499, but I have to round this off to two decimal places, so it's going to be 8.88 times. I need to write times here because rate of inventory turnover is always calculated in times. In the next, like for the next ratio, current assets divided by current liabilities, this is also going to be always the closing values are important. Opening inventory is only relevant for rate of inventory turnover. However, we need to take closing inventory in our calculation of current assets. So current assets will be inventory plus receivables, that is 6180, plus we have cash, that is 175 in the numerator, and in the denominator we have payables, that is 5500, and we have a bank overdraft which is 640, which is going to be my current liabilities in this case. So I have taken receivables, I have taken cash, I have taken closing inventory for the numerator, and payables and bank overdraft for my denominator in this case. So 12,130 plus 6180 plus 175 is going to give me 18,485, which is the numerator, and the denominator will be 5500 plus 640, which is going to give me 6140. So 18,485 divided by 6140 is going to give me 3.01 is to 1. is to 1. So we have $3.01 of current assets to pay off $1 of current liability. That is what this ratio tells you. Okay, liquid asset test ratio is current assets minus inventory. So total current assets in this case were 18,485 minus inventory is going to be 12,130. You need to subtract it and then you divide this by 6140. So 18,485 minus 12,130 divided by 6140 is going to give me 1.04 is to 1, which is my liquid asset test ratio in this case. Liquid asset test ratio basically tells you how many liquid assets do you have to pay off $1 of current liability. So liquid assets in this case would be liquid assets is receivables and cash. Inventory is not a liquid asset. Inventory is the least liquid asset. Okay, then they're saying Emma's rate of inventory turnover for 2023 was lower than that of 2024. That means rate of inventory turnover in 2022 was higher, which means there was more sales in 2022 as compared to 2023, which means that inventory is lying in the warehouse or in the storage area for a longer time in 2023. So just two problems which may be caused by Emma's low rate of inventory turnover. Number one is increased storage cost. So increased storage costs will be the number one problem, because when inventory is lying there in your warehouse, it means that it's going to take more space, and you don't have more space for new inventory. So that means your storage costs will increase. If you need to store more inventory, then you need more storage space. So you'll have to maybe rent out more storage space. So that means that will increase your storage costs. Also, one more thing, that inventory lying there in the warehouse or in the storage area, that means it is possible that the inventory becomes obsolete or deteriorates. So increases the chances of inventory becoming obsolete or deteriorating. So increases the chances of inventory becoming obsolete or damaged or deteriorated. So yes, this inventory will may become very completely out of date, or may deteriorate over time. Also depends on the product, because if there's a product, like for example it's a food product, food products usually they usually have uh, a smaller shelf life, but that means they have a shorter shelf life. However, uh, there are certain products which have longer shelf lives, so it's okay to store them for a longer period of time. But for inventory, some cases, yes, inventory becomes obsolete also. Okay, so that's it for this question. Thank you so much for watching.